Michael, there's a minute to go. You let me know if you're ready to start.
Yeah, thanks, Angela. I believe that the SENS announcement has been released. I think it's just gone 10 o'clock.
You can hear me?
Yes, I can hear you. Can you hear me? I can hear you.
Okay.
You can start.
It's on 10 o'clock. Good morning, ladies and gentlemen. I have the privilege to welcome you to our interim results presentation for the first 6 months ended to 31 December 2021. For the next 2 hours, Michael Sassoon and I, our Group CEO, will take you through our results and business performance. There will be Q&A at the end of the presentation. You are welcome to raise questions on the chat. Time permitting, we'll address them at the end of the presentation. The results presentation and booklet are now available on the website. Before we move on to the formal agenda, I'd like to use this opportunity to say farewell, as this will be my last results presentation with Sasfin. I've spent 4 very rewarding years with Sasfin. I would like to take this moment to thank our shareholders, the board, the executive team, and my finance team for what I can only describe as immense generosity. I am filled with so many wonderful experiences, and although the job is never done, I leave with many proud achievements and memories. I believe strongly in the Sasfin brand and leadership, and I'll be watching keenly as you grow and succeed in the future. As we move to the formal agenda, I'll take you through the financial review, and as mentioned, Michael will do the pillar review and prospects, and we'll then do Q&A time permitting. In terms of half-year significant impacts, it's one of our strategic objectives to streamline and simplify the group's business model. In the last financial year, we have entered into several transactions and made meaningful progress in this regard. The effects of some of these transactions do affect how we interpret the movements between the 2 reporting periods under review. For the first 6 months to December 2020, for the Efficient Group, we reported a sale of our 21% stake in the Efficient Group during December 2020. This resulted in a once-off non-interest income of 21 million and profit of 11.9 million. This had a headline earnings adjustment effect to the same number. The sale of the Sasfin Commercial Solutions business, we sold 100% of the subsidiary in June 2021. The P&L of this business is included in our comparative figures, but not in the current year. For the 6 months to December 2021, for IFRS 16, Sasfin concluded a lease for this new head office in August 2021, with occupation commencing in early January 2022. The resulting IFRS 16 lease liability and corresponding lease asset approximates 136 million and is on balance sheet. For the period August to December 2021, costs include depreciation on the right of use asset and interest expense on the lease liability in accordance with IFRS 16 for both the lease on this new premises and the lease on our previous building, which comes to an end in April 2022. The impact of the new lease on our income statement is 12 million of costs. With respect to the operational loss, as we reported in our June 2021 integrated report, during August, Sasfin Securities in the normal course of business participated in a corporate action where an error occurred that resulted in an operational loss of 45 million. The recovery process is still underway. With this context in mind, our headline earnings for the period is 54.8 million versus 26.9 million in 2020, representing an increase of 103%. The key drivers to performance can be attributed to total income decreased by 1.9% to 620 million. As a result of net interest income declining by 5.42%, owing to margin contraction in the rental book and higher cost of funding from increased term lend debt, the additional interest expense on the new lease liability had a further negative impact on the interest line. Non-interest income increased by 1.75%, with contributions from foreign income in wealth, fee income from new business, and increased utilization on facilities arising from our trade finance business and mark-to-market valuations, specifically in our specialized lending portfolio. Excluding the effect of efficient and SCS, which I previously mentioned in the prior year, income would have been up by 3.24%. On the cost side, on the impairment side, we decreased our impairments by 66% to 44 million in the current year. There is a separate slide where I'll go through the ECL in detail. The decrease in the impairment charge against amortized loans and advances has resulted in our credit loss ratio improving to 123 basis points from 240 basis points for the same period last year. Although also in the prior period, charge is inflated by a large impairment raised against our land bank exposure. Operating expenses increased by 12.84%. The operational loss is a key contributor to the significant increase. The additional depreciation charge on the building also inflates the cost base. Together with the decline in income, the cost to income ratio increased to 81.11% versus 70.48% in the prior period. Excluding the once-off operational loss and the impact of SCS, the cost growth would have been 5.75% with the CTI at 73.83. Our effective tax rate is normalized at 26.19%. The prior year was inflated by the impact of the efficient sale. This slide shows the movement in our headline earnings over the period and separately discloses the financial impact of the before mentioned transactions had on our business. As you will notice, the improvement in the credit impairment charge stands out as the key contributor to our performance and will be discussed in later detail. This slide shows the reported income statement, and having regard to the significant matters that I've already discussed, our group profits for the period is 53.9 million versus 39.1 million in the prior year, representing a 37.86% increase. Our ROE at 6.9%, although an improvement from the prior period, is not at the levels that we feel it should be. That being said, we have a sound strategy that we are implementing and making progress in reaching our key financial metrics. Following from transactions and initiatives concluded in the prior financial period, and in the current year's initiatives that are underway, we expect to enhance the group earnings on a sustainable basis and thus improving the ROE in the medium term. Our cost to income ratio at 73.83, representing more of a BAU number, is although higher than our range that we expect it to be, is in line with where the business is currently given our investment cycle. We do expect in the medium term that that number will come slightly down. Moving on to the balance sheet, the overall financial liquidity and capital base is strong and positioned for growth. Core funding comprises deposits from customers, debt securities raised, and long-term funding. That funding has increased by 13.75% to just over 9 billion. Customer deposits are up by a healthy 15% to 5.6 billion. We have lengthened the tenor of our book as the term deposit book has increased, which is positive for both our liquidity coverage ratio and our net stable funding ratio. The long-term funding increased to 723 million. And as we reported in June, we replaced our maturing funding with new DFI monies. This debt is now amortizing according to its agreements. Gross loans and advances are up by 10.73% to 7.7 billion. And what's encouraging is that all our asset classes have increased. And Michael will talk through that in much more detail when we go through the pillar performance. On the equity side, our ordinary shareholder equity is up 5.13% to 1.6 billion, due both to profitability as well as the impact of the repurchase of our preference shares at a discount, which was a positive impact on shareholders' equity. As a result, we've had a good capital adequacy ratio, which is up from the prior year to 17.5%. Given the strong balance sheet and our profitability levels, the company has declared a dividend of ordinary shares of 33.95 cents per share, which represents 20% of our headline earnings. On the slide is a summary of our balance sheet, and we have grown the total assets by 2.74%. The decline in cash and negotiable securities is as a result of the decrease in the funds on call, as we have reduced our exposure to funding under repurchase agreements. In addition, we have our net exposure on the land bank reduced as a result of capital repayments that were done, as well as increased provisions in the prior period. Further down on the slide, you'll see the 77% increase in our other assets, and that's as a result of the increase in the lease asset that we have put on balance sheet now. Going on to the ECL impairments. The total exposure has grown by 10.3% to 6.9 billion, with a 15% decline in the expected credit loss to 531 million. Our coverage ratio as a result moved from 9.38% to 7.18%. To set some context to this ECL, the results from our most recent recalibration of our model yielded an increase in the overall PDs from the inclusion of the additional 6 months of COVID impacted data into our model. The net increase in LGDs, given the methodology enhancements, resulting in an increase in our ECL, specifically in stage 3. And on the forward-looking information, despite the fragile economy, the economic factors did indicate a less severe than what was priorly applied. This had a positive impact in our ECL. The increase in our stage 1 exposure is due to the uplift in the lending activities, as well as an improvement in our arrears book, where deals have been cured back into performing. The corresponding decline in our stage 1 ECL is from the impact of the improved forward-looking information over the period, as well as improvements in our collection process. The result being that the exposure has increased from 80% in the prior year to a very healthy 86.1% in the current year. Moving on to the stage 2 and stage 3 exposures, you'll see a decline over the reporting period, and this is due to focused collections and curing efforts which began in earnest post the peak of the COVID-19. In addition, there were some meaningful settlements from long outstanding stage 3 accounts, which were previously provided for. These positive movements were offset by a move into stage 3 from large exposures, but with a low ECL due to the level of security we hold. Specific to the rental book, we did increase our stage 3 ECL for deals that are taking longer to cure and recover. The ECL is a function of the outcome from our recalibration of the model, and where expert judgment is applied to increase provisions where appropriate. This resulted in the coverage ratio increasing in both these portfolios. As mentioned at the bottom of the slide, you will note that while the land bank default has not been cured, it has made capital repayments of approximately 89 million since June 2021, further increasing our ECL coverage ratio on this exposure. A lot has been said around the exposure and the ECL performance, but the key takeout here is that we have grown our loans and advances book with better credit quality, where we now have 86% of our stage 1 book. The overall decline in the coverage ratio is very much as a result of the improvement in the staging of the book. And in 2018, we took over the ATFS book, which has now rolled off in the current period. And at the height of COVID in 2020, we did tighten our credit, resulting in the dip in the book. We are now tracking back in line with our pre-COVID levels and net of the ATFS book. Moving on to liabilities and equity, we have covered all the significant matters already, but to reiterate, the deposits from customers increased by 15% due to both long-term and transactional deposit growth. The lease liability from the new premises is now on balance sheet. The ordinary shareholders' equity at 1.6 billion benefits from the preference share buyback. Our core funding base is now at a 5-year high at 9 billion, with the deposit maturity profile strengthening and lengthening. On the CAR side, our capital adequacy ratio remains strong and at levels that support future growth. The onion graph shows the pillar contribution to the group's operating profit for the period, and Michael will go through the details of the pillar. We have made changes to our management structure since July 2021. We brought together what was previously reported as business banking and capital, including trade and data, under one pillar called business and commercial banking. Included in our group and treasury function is our non-core private equity portfolio, as well as group costs that have not been distributed to pillar and held at the center, and that would include costs such as the IFRS 16 building. The December 2020 has been restated to reflect these changes. In closing, before I hand over to Michael, I'd like to summarize by saying we have been making progress around our strategy, and the group has undertaken initiatives to ensure focus on the core business and to optimize capital. Barring the one-off impacts mentioned, the core business is performing well. The financial, liquidity and capital position of the group is strong and well managed, with an impressive double-digit growth in both loans and advances, as well as customer deposits. I thank you for your time, and I'll now hand over to Michael.
Okay, thank you, Angela. Good morning, everyone. Let me just start off by saying a big thank you to Angela for her years of service at Sasfin. Angela joined in 2018, and she had to navigate us through a change in auditors, through the implementation of our IFRS 9, through COVID, through the land bank impacts, and she has always done so with huge commitment. And we're very sad to see her go, but we wish her well in her future career. And just since she's resigned, her commitment just in these last couple of months is indicative of the person that she is, and just a big thank you to Angela. Sorry, Angela, the presentation has just come off full view. Okay, anyway, let's move on to the next slide. Sorry, I'm not. Okay, so then to move on to asset finance. Apologies, I'm just slides not yet coming up. Thank you. Thanks, Angela. So just to say that in asset finance, if you could move on to the next slide, you'll see that income has dropped by about 9%, even though the book grew quite positively, as Angela mentioned. A portion of this book is effectively fixed rate, and with the slight increase in prime over the last few months, that there's been a bit of margin contraction over there. We also, in the base, we still had the final ABSA book that we had bought many years ago, which is now run off. And therefore, I think that we don't expect the income to continue to reduce as it has. And the loan growth that we did achieve, much of that happened right at the end of the first half. And therefore, we expect income to move in the right direction. In terms of the credit impairment charges, while there has been an improvement to 67 million, that still is higher than our through the cycle range and where our expectations are. As Angela did indicate, we have provided for more against our stage 3 portfolio. That's our non-performing assets in this business. And that we kind of moved from about 70% to about 72% to about 77%. We don't expect that kind of increase to happen again. And therefore, we expect the impairment outlook to be better in the second half of the year. What also has happened is as we've moved towards more of a decentralized model and we're embedding stronger capabilities into each of our pillars, and as we've been investing in our specialized equipment area to grow our software capabilities and our solar capabilities, we have seen an increase in costs in this area. So all in all, that does show quite a negative drop in profit from operations, but we believe that the second half will be quite a bit better in this business, and we're comfortable with the investment that we're making into the area. So as a lot of this is a repeat of what I've just said, but just to mention that, you know, in our specialized equipment finance, and this is a story that we've been telling investors for a while, is that we are looking to diversify our asset types in this business. That grew by 18% in the first half of the year, which is exceptional growth in this economy. We also saw growth in our older, more traditional rental finance business there of 5.41% off a much higher base. So 5.4% in this economy where we have a decent market share is very pleasing indeed. And there were obviously the supply chain impact. So it made it all the harder to achieve that growth. In terms of the commitment is that we are looking to continue to diversify into other asset types, and we are seeing a bigger portion of our book across a more diversified spread of asset types. And then on the credit impairment charge, that I did give some indication on already, so I won't repeat anything there. Just to mention at the bottom over there, you'll see that the stage 3 coverage ratio has gone from 71.5% to 77%. As a result of more conservative provisioning on our non-performing assets. We don't believe that 77% will grow again, and therefore that was quite a material impact in why the impairment charge was where it was, relative to the fact that the book actually improved if you look at the increase in the stage 1 portfolio. We then move on to business and commercial banking, and Angela did mention the changes that we've made in this pillar. So what we have done, and this is just to remind everyone, for those especially who weren't in our full year results, we essentially had 2 different businesses. We had what we used to call Sasfin Capital, and we had our digital business banking and foreign exchange business. We have now pulled those together into a business and commercial banking pillar. We have changed a lot of the capabilities in that area to move away from, especially in what was Sasfin Capital, away from private equity and property equity more into commercial property finance and term lending. That's been quite an important shift in the business. We've also introduced new products, including a revolving credit facility, and we procured the Nasira guarantee to enable us to lend into smaller businesses. Inside here, we also have our digital banking capabilities for small business in the Beyond platform. We streamlined this business by exiting some non-core businesses, including what was Sasfin Commercial Solutions and our JSE sponsor business. So we've been very busy in bringing together a single business and commercial banking operation, which can really deal with different size clients along their journey. From a smaller business where we can offer them banking, credit, foreign exchange, and we are going live with an overdraft and a new digital Forex platform, all the way up to quite a large business who might have a need for a 50 million rand or 100 million rand credit facility where there's a bit of tailoring and structuring which is required, whether that's in the form of a trade and debtor finance facility in terms of their working capital requirements, or in the form of a term loan, either off the back of a property or off the back of a business, whether it's for acquisition finance or for a leverage buyout or whatever it might be. And this change has really put us in a very strong position. There aren't any tier 2 banks that we're aware of that has such a comprehensive offering into the business market, both in terms of the smaller businesses and the medium businesses. And in particular, in the medium businesses, where often people hear horror stories about how a business's relationship with a bank might go, but we work very closely with these medium businesses. I often personally will engage with them, as will our heads of credit and chief operating officer, to really see how we can support our deal makers and transactors who are real specialists in helping solve these issues for a medium business in a way that works for them and relatively quickly. What's also very important to note is that we have really strengthened the leadership layer of this business. We appointed Sandile Shabalala, who started on the 1st of January. He was previously the CEO of Time Bank, and before that, he was the managing executive of Nedbank's business banking operations. We've also strengthened this team with the appointments of a head of business banking and a head of commercial banking who come with deep experience in this area to complement the strong team that we already have been building over many years. So we've put together what we believe is a very capable team. We've invested heavily into the systems, and we're continuously enhancing and developing the product capabilities and the distribution and credit capabilities. And we are seeing this come through. Our lending growth is increasing. We are winning more primary banking relationships. Our transactional deposits, albeit off a low base, have doubled year on year, which really is your cheapest form of funding, which is very important that we continue to see that growth. We've seen revenue generation improving, and that's off the back of a smaller business because we exited the commercial solutions business and the JSE sponsor business. Despite that, revenue has grown. And while we're very committed to the digital capabilities, we understand the need, especially into these larger businesses and businesses with big aspirations, to provide them access to decision makers and to coverage bankers through the investment we've made in the relationship model. And by bringing this whole thing together, we are avoiding some duplication of costs. So what's very pleasing, and Andrew will show you the next slide, is that we have seen a profitable 6 months for this area, which is off the back of investment over many years. Income growth of 9%, and if you strip out the commercial solutions business from the base, the income growth would have been even higher. Important to note, however, is that there was a big reversal in credit charges. This was off the back of, in particular, large recoveries. But Angela also mentioned, and she touched on, and it's important to note, both in the asset finance business and the business and commercial banking area, our stage 1 portfolio, that means your fully up-to-date portfolio, was 80% of our total loans this time last year. That's now grown to almost 87%. And that might seem like a small number, but it's R1 billion. It's R1 billion growth in completely up-to-date loans in this last 12 months in a very difficult economy where we're still utilizing quite a conservative credit approach. Some of that is curing of assets, but a large portion of that is growth. But another way to look at that is that your underperforming and non-performing loans went from 20% down to about 13 or 14%, which is a 35% reduction, which is significant. And that, to some degree, explains this reversal in credit impairment charges. Obviously, that's unlikely, that will not repeat. Even though we have provided for any clients that we're aware of that we think are a high risk. But it's unlikely that you'll get that kind of reversal again. So I think if you apply a through the cycle credit loss ratio over there, this business will be closer to break even than the healthy profits it's showing. But essentially as a pillar, it's now in a break even territory, maybe slightly positive. And you can see that the operating costs have come down. Some of that is as a result of the saving through closing our Sasfin Asia operation and exiting our Sasfin Commercial Solutions business and the streamlining activities that Angela's mentioned. Because if you heard what I was saying a bit earlier, there's been quite a lot of investment in this area. So that reduction in costs is not a result of not feeding this business. We are feeding it, and there's a lot of investment we still would like to make into this area, but through the streamlining activities and really focusing on our core capabilities, we have been able to still procure a reduction in operating costs. In terms of the drivers of performance, I think that this probably I've largely covered already, but net interest income is up 33%, which is really core income growth, transactional deposits, and we've seen healthy growth in our revolving credit facilities. There's been strong balance sheet growth in our specialized finance and property lending, our trade and debtor finance, which in many ways is the biggest yardstick of where the economy is at, because businesses will only really invest heavily in their working capital cycle when they start to regain confidence in their business and their growth potential. And we are seeing improved utilization and increased new business volumes. And hopefully this is a sign that there is positive momentum starting to appear in the economy. Most of the lending that we do is growth lending, and therefore, over the last couple of years, it's been difficult to grow our book because it's been a very difficult economy in which to grow a book. But to grow your book by R1 billion, a business of our size, that does suggest that the demand for credits is definitely been higher. I think it's also a whole lot of things that we've gotten right. And hopefully that momentum will continue. And the credit charge, I did indicate the reasons for that. In terms of our wealth business, so unfortunately, the wealth business was impacted by this large operating loss that Angela mentioned, which we are working with the insurers on. But we have provided for the full loss. We haven't assumed that we'll, in our numbers, we haven't assumed anything, but we do believe that we have a strong claim. But just to say that if you strip that out, the costs would have actually improved year on year. And then if you look at the income line, the income dropped by 2.6%, but it's important to note that inside the December 2020 numbers was the gain on the sale of Efficient of about 20 odd million rand, plus a bit more actually, because we also had the associate income for the first 6 months of the year associated with Efficient. So if you strip those two things out, there would have actually been quite healthy income growth. So that explains the big drop in profit year on year. But if you look at the actual core business, and you move on to the next slide, Angela, please. You'll see that this business is actually in a very healthy position. We grew our assets under advice and management by over 20%, from 51 billion to 62 billion. There was obviously some market support for that growth, but a lot of the assets that we are writing are fixed income assets. A big portion of this asset growth is a result of net new flows, given the strong distribution that we've capabilities that we've invested in and built. Our foreign assets now comprise 25% of our total assets under management, which is a wonderful place to be. It creates a natural rand hedge in the business. And we have continued to strengthen our team in this business. There were some recent new hires, which the media covered. And we really have an exceptional team of fund managers and portfolio managers. We've invested heavily in distribution, which I think gives this business a really healthy platform and such a people-centric business to continue to grow in. And our investment performance continues to be strong. We won another Raging Bull Award last month, and we are recognized as we were once again recognized as the top advice broker, our Sasfin Securities business, in the Intellidex Top Securities Broker Award. So I think that the investment that we've made in this business is looking very healthy. And if you look at operating profit, it grew by 64% from 35 million rand to 57 million rand. If you strip out that the operational loss and the impact of efficient. So I think that this business, which is so well positioned, both in the private client space and in asset management space, for further growth, I think is done very well. Just to make that point. So then if we move to prospects, so just to say that where we've moved to is to a position where we have these three decentralized pillars, all built with scale in mind. Our asset finance business and wealth business already have healthy scale, but there is good opportunities to grow both of those platforms. Our business and commercial banking business has been a long investment cycle that we've been in this business. We've done it in a way where we've always thought through sustainability and scalability, and it's very pleasing to see what's happened in that business. Each of these pillars have focused leadership with strong management teams, and we have strengthened the management teams, and we are embedding more capabilities in the pillar. So we're reducing services provided at the center to ensure that there can be real focus on growing each of these businesses, very much centered around the clients. The needs of the clients in each of these three pillars is slightly different, or quite different, I should rather say, and therefore to build very real focus supports. And the other big benefits of a more decentralized approach is it enables greater agility, less bureaucracy, because it's less complex when navigating what each of these different businesses needs, and it enables us to be very people-centered as a business. So this has been quite a big shift that we've been undergoing for a number of years through the appointment of Sandile and the bringing together of the business banking and the capital pillars. That was really very much the last piece of the puzzle. And each of these pillars are now well positioned through their leadership and management teams and their client offerings, and their product offerings and the distribution capabilities to deliver excellent service, which is so central to everything that we do at Sasfin, and to grow their businesses. There are golden threads which combine everything in terms of our common brand, shared infrastructure. We're all in one building. There are benefits to a certain degree of centralization, but that's very much around the brand, the infrastructure, and governance, which is provided centrally. Another important element that we've been very focused on, as I think everyone's aware, over the last few years, has been our technology journey. And we've built this technology journey with a client-centric mentality. And essentially, there are four in each of our businesses, whether it's wealth or asset finance or business and commercial banking. We ask those teams to think through four lenses. The one is to partner with fintechs, either through taking stakes in those businesses or through APIs to provide capabilities into those businesses in order to offer comprehensive platform services. And we've seen that very successfully in our DMA relationship, as well as our Hello Pays relationship, by way of example, but there are other fintech partners that we have. We've got a stake in a business called Payable, which supports small businesses through lending, and we continuously look at different opportunities to work with different businesses to support a client-centric journey. We then also do quite a bit of in-house build. We've built our Beyond platform. We've also built and integrated our Sasfin Wealth Investment platform. These are platforms which need continuous work and development. They're not exactly where we would like them to be right now. We're very focused on the last mile of each of these platforms to ensure an improved client experience and a user experience. Then there's the data layer, and this is informed by both the regulatory requirements as well as the business requirements. The regulator, the Prudential Authority, expect all banks to be able to analyze their data in terms of risk, which is this RADAR project, which stands for Risk Data Aggregation and Risk Reporting. which is quite an important regulatory piece, which we've invested heavily in over the last few years. But that has also resulted in a single data warehouse, which will enable us to better understand what our clients need and how to manage our business. And as we know, the data is kind of the next frontier in terms of technology. And all of this is off the back of simplified infrastructure and architecture, with the aim of moving more of our capabilities into the cloud. When we moved buildings, by way of example, from Waverley to Sandton, we didn't move our servers to Sandton. They're now offsite in Terrico, which does enable a much more simplified infrastructure, much more flexibility, and better security. And so these are the four lenses through which we apply our minds when it comes to technology. Essentially, if we just go back a step, Sasfin's whole purpose is to support businesses and savers and investors. And nothing could be more important for the economy than, on the one hand, to try and instill business growth and to support and enable business growth, and on the other hand, to support a savings culture and to improve the outlook and the ability for investors to retire better. And that's very much what we committed to. So we see our business as something which is very purpose-led. And it's pleasing to see this increased activity and demand for credit, as I mentioned earlier, and we hope that this momentum will continue. And we are doing a lot of different things in both our asset finance and business and commercial banking areas. Through the Nasira guarantee, we are able to support smaller businesses at an earlier stage, including women and migrants and youth-led businesses. We've already deployed 100 million rand in terms of that capability, and that's continuing to grow each month. And then on the other hand, we've got this investor community, and obviously we recognize that the world is going through a very difficult time, and obviously our thoughts and prayers go out to the people of Ukraine, and we hope that there is a peaceful solution sooner rather than later. But meanwhile, this is having a big impact on markets, how we construct our client portfolios to navigate these difficult times. Is something which is very important and something which our team thinks about deeply in order to protect our clients' wealth in this next phase. You can move on to the next slide, please. So if you just think about where we're at, it's been a rocky few years in South Africa, and Sasfin has had a lot to deal with in terms of COVID, in terms of new regulatory requirements such as IFRS 9 and radar, in terms of simplifying our business model. We did a hell of a lot last year in terms of exiting the preference shares, Sasfin Commercial Solutions, Sasfin Asia. We obviously have been dealing with the land bank default. And just to mention there, Angela did touch on it. There was some capital repayments. We haven't released any provisions against our land bank exposure, which means we are carrying quite a healthy provision against our land bank exposure. And the land bank has now been in default for almost 2 years. The default hasn't yet been cured. The Minister of Finance did indicate in his recent budget that there is equity available to support the land bank to try and come out of the default. We are concerned about the length of time that this has taken, and we're considering all our options to try and protect our position. But it's been a very rocky few years. That being said, we emerge into 22 with several positives. Our investment into business and commercial banking is showing real signs of healthy growth. We've seen healthy growth in our key financial drivers. We've grown our loans by 10%. More importantly, we've grown our stage 1 loans, which is our up-to-date loans, by 18% year on year. We've grown our deposits by 15%. Our transactional deposits have doubled in this last year. And we've grown our assets under management by 20% to 62 billion rand. And to achieve that kind of growth in this market is very pleasing. And we believe that growth will start coming through into the income in the periods ahead. We've also successfully moved into our new offices, and we were hoping to have lots of people join us at the office today, but the RSVP suggested that the vast majority of people preferred to dial into the session. So that's why it's a completely virtual session, but hopefully at the full year, we will offer an in-person option as well. And these new offices that we moved into, which we hope that you'll come and visit us at, are incredible offices which have been designed for a hybrid work model. We've taken less space at far reduced rentals. In terms of IFRS 16, we still carry the Waverley office in our income statement until May, when the lease actually ends. So there is a bit of a duplication for the next 4 or 5 months, and there was since September when we took ownership or occupation of this building that we're in Sandton. So there's a bit of a double count there, but in the years ahead, there should be some meaningful savings, which should be felt in the income statement. And then in terms of what we are focused on, we're very focused on strengthening our platforms to enable growth and to improve client service. And that's something which we've been investing quite significantly in. We continue to invest in distribution to drive scale. We are working quite closely with our human capital team to explore and to enhance and develop the way that we work and support our staff, which is really at the end of the day, we are our people, and therefore it's very important that we deal with the changing work realities to really provide a exceptional employee value proposition, which ultimately should support our clients. We will continue to explore opportunities for inorganic growth, as long as those opportunities are quite aligned to one of our 3 pillars, and quite focused on not distracting the business, but really in support of achieving scale in each of these 3 areas. And then to continue to make the difference that we've been making over the last few years, by contributing to society through supporting both businesses and savers. So I just want to thank everyone. I would like to thank Angela once again, and to thank our board and all our stakeholders. I think our regulators might be on the line, as well as our staff, our clients, our investors, our shareholders, and all stakeholders for your support over this time. And I think that we're in a very exciting position for the year ahead, and we just hope that the economy will continue to show some of the positive signs that we've seen in the last few months, and then a bit of momentum will start coming into the economy, even though we are very conscious of the global situation and the macro reality, which does create a lot of risk in terms of the outlook. So thank you very much, and I we'll take any questions now. I see we have one question over here so far. Is the company, I'll just read out the question. You can put the question up on the questions up on the chat. Is the company easily accessible to rural development movers and shakers? So thank you for the question. What we've tried to do, especially in our banking area, is to ensure that our offerings are available digitally, so that you don't need to come into a branch in order to open up a bank account or to apply and be granted credit. And that's very much been the case. Whether we have done enough by way of marketing into those areas is a question. And obviously, in terms of credit, there are challenges. In terms of banking, a lot of the call it the rural movers and shakers. The other thing just to mention is what we have been doing in our property finance area is we have been supporting developers in the social housing area and the affordable housing area. So there is quite a bit that we have been doing in that space, and most of that has been kind of more in the rural areas. So I hope that addresses your question. Thank you, Andile. Any further questions? Just to mention that the presentation and the recording of this presentation, as well as our booklet and SENS release are all available on the Sasfin website. Okay, there are a couple more questions over here. Expected business impact from the Russia and Ukraine conflict. So we have been spending a bit of time on this as a business, and our risk team is doing an assessment. Obviously, there are many different potential impacts that could emerge. You know, at the moment, we aren't seeing anything which, in terms of demand for credit, just even the last few days, we've seen the demand for credit still very much is reflective of what it's been the last few months. To what degree, you know, sanctions will, you know, disrupt supply chains, and to what degree there could be other countries involved, it's very difficult to foresee. And I would love it if someone could help us understand what those different impacts could be. But at the moment, we are doing those assessments. That's all I can say at this point. How come business loan thresholds are so high? So in order to obtain a business loan from Sasfin, you have to have a 1 million rand turnover or more. Our business is very much, and our lending products are very much geared towards growing businesses that we believe can grow and that can grow with our funding. And therefore, they aren't built for micro businesses with a turnover of less than 1 million rand. Also, in terms of the arrangement that we have with the FMO in terms of the Nasira guarantee, we carefully looked at where we believed we could offer credit at a reasonable rate, at a reasonable credit default level, in a way that can really support business growth. And we determined that at this point, there'll be 1 million rand or more in terms of turnover. So that is the answer. Thank you for that question, Godfrey. Yes, there's a similar question here on turnover of 1 million plus. So unfortunately, within Sasfin, we aren't able to provide any credit for businesses that aren't yet achieving a turnover of 1 million rand or more. There are different lenders out in the market, which I think are, you know, you can Google. But if you would like to reach out to our business banking team, I'm sure they can point you in the right direction in terms of what other options might be available. Another question on business credit. After how long does the business have to bank with Sasfin before it can qualify to apply for the business loans and overdrafts? Well, it depends on the business. There are many businesses that haven't yet banked with Sasfin where we're comfortable with the credit risk and we can provide them a loan. It really depends on the specific business. So it's a difficult one to answer that. As offer home loans to registered businesses and individuals, we don't offer home loans at this point. We are looking at offering more commercial property finance into smaller businesses, but that's really for their business premises, not for the entrepreneurs' homes. But one thing which we are considering, and I think it's more of a medium to a longer term question than something that we'll do in the short term, is what additional steps can we take to support the entrepreneur behind the business? Whether we provide those services or we do that through collaborating with other parties who specialize in these areas is something that we're still exploring. And then, are there any plans to support small businesses through enterprise development initiatives? We do support small businesses through enterprise development initiatives. And if you reach out to our marketing team, they might be able to give you some more guidance as to the type of small business support that we have provided through our ED initiatives. A lot of interest in what we're doing in the micro space of the market. So we'll take that into our strategic thinking to see if there are even more steps that we can take than we have been. But obviously we've done a lot already through our, through providing loans to many businesses who wouldn't qualify, even though they had turnover of R1 million or more, and through our Beyond digital banking platform. But we will look at those. Thank you for your interest and for those questions. Any further questions anyone would like to ask? Okay, I don't see anything else. So just to thank everyone for your participation, for joining us this morning, and for your interest in our company. And we appreciate it very much, and we wish you all the very best for the rest of the day. And thank you once again.